there, welcome to this very special episode and the special coverage of the GST rate rationalization. Well, the meeting is just around the corner. All eyes are glued to what is going to be discussed, which sectors stand to be affected, what are the final slabs that we'll get to see, and what the impact is going to be on the overall economy. I am Snehisha, with me is Ankur Mishra. And Ankur, lots to talk about when it comes to this entire rate rationalization overhaul, the biggest for India after GST was introduced a few years ago. And well, yes, slabs and the impact, lots to talk about.
Lots to talk about, and the biggest event, if you talk about the month, is here. September 3 and September 4 is the meeting, and we'll get to know whether or not GST Council actually approves it. But to know what exactly is expected in the meeting, I have with me Prakash Priyadarshi, who's keeping a very close eye on the GST Council meet. Prakash, over to you.
Yes, it stays set for next generation GST reforms. In fact, the GST Council is scheduled to meet on September 3 and 4 and expected to take some big decisions. In fact, a complete overhaul of the GST after 8 years of its implementation, which is expected from the next GST Council meeting. Sources are indicating that the process has been initiated. In fact, the government is committed to implementing all these rate reduction before festival season. So you can clearly assume the seriousness within the government. You are aware that the GST GOM on rate rationalization has already accepted the centre's proposal for two rate structure, essentially 5% and 18%. Along with that proposal of doing away with the 12% and 28% has already been accepted by the GOM, and therefore it's going to be an extraordinary GST Council meeting. As per the proposal, a 40% slab will be created for thin goods and luxury items. 99% of items under 12% slab will come under 5% category. Items under 28% category, such as cement or some other items, will be shifted to 18%. Luxury cars, bikes, pan masala, tobacco to attract 40% GST. So these are the broader picture. Along with that, opposition states are little apprehensive when it comes to revenue losses, which is likely to be in a range of 1.5 to 2 lakh crore as per their estimate. So they have requested the central government to come out with a clear assessment as to how their revenue losses are going to be compensated, and therefore they want clear mechanism to protect their revenue interest. Along with that, they also want additional levy beyond 40%, especially on thin goods and luxury items, to compensate their potential revenue losses. So these are the broader proposal, but so a very significant development coming in, and we are expecting some major announcements from the next GST Council meeting. Back to you.
All right, Prakash, and while you're with us, just on that note, help our viewers understand what are some of these major announcements that we're expecting to hear from the September 3 and 4 meeting. Take us through some expectations that the industry has, and what can our viewers also expect to hear from the meeting. Prakash?
Yeah,
Yes,
I can't hear you.
Okay, so we'll try and reconnect that line with Prakash in a bit to try and understand what are some of the key outcomes that we can expect to hear from this September 3 and 4 meeting just around the corner. And we'll try and patch that line again. But in the meantime, let's discuss what the implication of this entire rate rationalization exercise could be on the economy, as well as what the tax impact of the same could be, what the final incidence on the consumer could look like. And to do just that, let's welcome on board our guest today on the show. We have Mr. Madan Sabnavis, the Chief Economist at Bank of Baroda, joining us to give us a clearer insight of what the economic impact of this could be. We also have Mr. Mahesh Jaisingh, leader of indirect tax at Deloitte. Deloitte India joining us to give us an impact on the common man and what the overall tax impact of this rationalization exercise could be. Welcome to the show, both of you. And Mr. Sabnavis, let's start with you. Give us a sense of what the economic implication of this could be. There is still a lot of conjecture around what the final slabs could end up being. But overall, on one hand, we are also hearing that while this is expected to provide a boost to the economy, on the other hand, there will also be some states that will be reeling with some revenue loss. So give us an even picture of what this situation could play out as.
So as you mentioned, what today we are talking is a matter of conjecture as to what exactly is going to happen. But let's assume that the 12% slab goes to 5%, and most of the goods which are in the 28% slab go to the 18% slab, with some of them moving to the 40% slab based on them being considered sin goods or luxury goods. So on the whole, I think the objective of the government is to bring about rationalization in the GST structure, because we do remember that when it was introduced in 2016, it was said that there were just too many slabs, and normally countries operate with just a single slab. So I think we are going towards some more rationalization in terms of number of slabs. Second, I think when we are talking in terms of lower taxes which are going to be levied on a large number of goods, this would necessarily mean that there would be certain gains for the consumers, which is probably quite timely because we're talking of it in sometime in the month of September. And let's assume that it does get passed. I think it comes just at a time when the festival season has begun in India, where there would normally tend to be large expenditures on things like clothing, jewelry, maybe houses, automobiles, so on and so forth. So I think this is probably the big takeaway, that just at the time when we have a tariff issue, there are lots of concerns about what could happen to the economy. The government on its part is probably trying to say that, look, one, let's make sure that we lower the GST rates, which could give a boost to consumption. The second thing is, of course, that the moment we see the GST rates come down, there will be a tendency for the input prices to come down, especially for the SMEs, which could be impacted by the tariffs which have been imposed by the US. So to a certain extent, it will be able to placate them, though it's not the full solution, but definitely there will be certain cost advantages which they will be coming through. Now, any such exercise, when there is transfer of resources from the government to the consumer, because if the consumer is going to spend more, it's because the government is foregoing a certain amount of revenue. It's but natural that as far as the center and the states are concerned, because GST normally is 50% goes to center and 50% to states, there would be a tendency for this transfer to take place from both the center and states. So if the states have a concern about whether their revenue will be affected, it would definitely, for both levels of government, there will be revenue coming down. But the way I look at it is that when we are talking of any kind of reform, it takes a medium-term view. So while it may be so in the current financial year, but if you look over a longer-term horizon, when we're talking of India's growth story continuing on this path of 6.5–7% growth, there would be a tendency for higher consumption to take place, which will more than make up for this revenue loss, which one may temporarily see in the very short run in this particular financial year.
All right, Madan, point taken. Let's also welcome Avnish Roy to the panel. Avnish will come to you, but before that, Mahesh, I want to ask you about this particular event now. Ever since Prime Minister Narendra Modi announced about GST reforms, there is a lot of build-up to this event. We have seen many news flows after that after the two-rate structure will be there. There will be ease of doing business. There will be benefit to certain sectors. But as a process, after this September 3 and September 4 meet, how does this work out? I'm sure whatever the expectation is there, even if that is fulfilled, when will this be applicable?
Thank you. I think Madan covered aspects relating to the consumer. For starters, I'm excited as well because this is going to boost sales, and the economy is going to be getting a push. We talked about the government, we talked about consumer, but I'm going to talk about the third stakeholder, which is the businesses. So businesses are looking at the first question that you raised, Ankur. How soon can this happen? Technically, once the constitutional body of the GST Council announces the revised rate structure, it could technically come in a day or two later. But I, for one, think that there will be at least some time frame that's given for companies to be prepared to be able to move into the new rate structure, one. Two, We do have the upcoming festive season from Navratri starting from September 22nd onwards. And therefore, if I was a betting guy with a quarter end also coming in, I would be hoping that we have an announcement which is slightly before we get into the festive mode. So that's one part. I think the second part, which is somewhere linked to the rate going live, is a bit of nervousness from businesses. And they're optimistic because the GST Council has from time to time issued a lot of friendly measures in terms of actually giving this benefit in totality. It heavily depends on how well the inverted duty rate formula is worked upon. So in a nutshell, if a product moves from 12 to 5, we all expect a product that's 100 rupees with 12 rupee tax to become, say, 105. Very well. But the business may continue to buy inputs at a higher rate of 18 or in some cases even higher. I think business is looking at the date for the revised rate as 0.1, but they're very eagerly and anxiously looking at how the inverted duty, provisions will apply for stock in trade as well as for an ongoing basis where they manufacture a lower rate product. I can cover that and elaborate that as well.
I appreciate that point, and we'll get back to you and address that. Let's also get into conversation with Abneesh Roy, who's joining us to help us decode the impact of this entire rationalization exercise on the consumption front. Abneesh, hi, and thanks so much for your time today. And I want to get your sense on just that, right? Because the festive season is round the corner. You have a big boost coming in for staples. But while all looks good on that front, Abneesh, what's your sense on categories like tobacco, cigarettes? You have aerated drinks that have now been positioned to move to that higher 40% slab under that sin goods category. What could the demand approach be now for sin goods, and how does this shape up the entire balance between staples and discretionary spending?
Yes, we see this as one more positive for the broader FMCG consumption. So we have already seen multiple things pan out on the positive side last few quarters. So we have seen rural demand recover. We have seen monsoon this time being on the right side. We have also seen tax rebates by the union government earlier, and we have seen food inflation at a low. Now this step which will be announced this week, we do see that the lower end of the consumption and the mid end of consumption will see a benefit. Coming to a specific question on the sin goods, now there are two parts. One is on the cigarettes. We see more of a bucket reclassification. So currently there is a 28% GST, and then there is a cess, and there are more taxes. What we see is 28% obviously moves to 40%, and then the cess gets reclassified under another name. Overall, we see largely status quo, or maybe slight increase can happen. On the aerated drinks, again, it's a 28% plus 12%, so it's already at 40% overall. So we don't see any significant change there. So net-net, except these one or two segments where maybe a status quo will be there, lot of other FMCG, especially Bikaji, 70% of the business at 12%, Imami 60% at 12%, Dabur 24%, Nestle 25 to 27%. These could be the beneficiary. And if the soaps, detergent, etc., they also get classified, toothpaste gets classified as essentials, and they get taxed at 5%, then Hindustan Unilever, Colgate also will benefit. But currently those are at 18%, so we'll need to see whether that actually happens.
All right, Mr. Madan Sabnavis, talking about economics of this GST announcements, one side is definitely saying that after these announcements will be made, government will have to make up for this revenue, and therefore questions are raised whether or not there will be fiscal prudence, which are the areas where government will look into. How government may balance this out, because on one hand GST announcements are made, we are already reeling in under pressure due to tariffs announcements. So how do you think government will strike the balance?
See, I'm quite sure the government has already worked out the maths behind it, and therefore they're aware of the fact that in the next 6 months, if at all we are having this kind of a major reform in terms of reduction of GST rates, there will be a certain impact in terms of revenue. But we should remember that there have been certain other positive developments on the revenue side. Like, for example, if you look at the transfer from the Reserve Bank of India was much larger than what was expected. And there has also been some inherent buoyancy, which we have seen in other tax collections so far this year. So the government will be having these calculations ready. So therefore, I think contrary to the nervousness which was expressed by the market, I think that the fiscal deficit of 4.4% is sacrosanct. It is something which is going to be achieved. And therefore, I really don't see any major challenge as far as the fiscal balances are concerned. As far as the states will also go, I think while there could be certain shortfalls in terms of GST collections for the second half of the year, we should also remember that states are more committed to the fiscal deficit ratios because they're not supposed to go beyond the 3 or 3.5% numbers which are there. And normally this could mean that they will have to probably cut down, prune certain other kind of expenditures in case other revenue does not increase commensurately. So I'm sure there will be a good balancing act which is done by the government, which I think is fairly reasonable to expect from the government, because when you have a big reform like GST coming through, it's but natural that there will be adjustments which have to be made to the budget. But at the end of the day, if the center and the states are able to move around that particular number which has been targeted for the year, I don't really see any major issue in terms of maintaining the deficits as well as not coming in the way of economic growth.
Okay, and before we wrap up this conversation, Mr. Jai Singh, just want to get your sense on if these slabs actually play out the way the street is expecting them to. How much in line or how much closer would that bring us to what the global practices are when it comes to some countries who have adopted GST? Because I also do remember when GST was first brought into practice, we drew a lot of inspiration from the tax slabs of Canada and France. So are we heading in the right direction, or what is the global benchmark over here?
Yes, I think as Madan initially mentioned as well, from our GST at 8 survey at Deloitte, 40% participants asked for rate rationalization, and that's remained the number one policy ask. It's interesting that even when we map out the global best practices, the number one point is about rate rationalization. So with this straight answer, will it get completely close to the global? Yes, it will get closer, but not fully there. But I think we're getting much there because many countries just have a revenue neutral rate and an exemption. I, for one, believe an exemption is very dangerous because what that does is that impacts your credit chain. And most countries even have a sin good rate. So the 5% rate is slightly unique in that sense, but it's the right thing given where we are in this journey. And the actual benefit getting passed on to the common man is heavily dependent on a 5% rate where the credit chain exists. So that's my response for you, Sneha. And I'm repeating at the cost of repetition that we are not discussing too much because that's a post-GST Council aspect or a very technical aspect on one breath. But the inverted duty rate formula, which is also called out in the press release after the Honorable Prime Minister's speech, that there is some focus that's going to be there. I think when that comes in totality, we'll see alignment not only on the rate front with the global the VAT laws, but also on how the VAT and working capital benefit gets accrued to the supply chain, which could be large or MSME.
Right. Avnish, I want to come to you. If these announcements are made, and particularly about FMCG companies, what should companies do? Will they be passing on these prices, or will they improve the margins? How should corporate India expect them to behave?
No, I think once the cuts happen, the anti-profiting clause should come back. I don't think that will be an option. Companies will have to pass it on. In the lower unit packs of 2 rupee, 5 rupee, 10 rupee, generally the grammage, obviously the grammage increase will happen. So from 12%, if it moves to 5%, 7% kind of grammage increase will happen. And on bigger packs of, say, price point, say above 20, it will be a price cut. So I don't think companies will have the option to really retain margins, yes, because of the operating leverage, overall profitability could increase. That's a function of the business. But I don't think there'll be a the anti-profiting clause will come back, and companies will also look at the competitive nature of FMCG. So even if the anti-profiting clause is not there, let us just assume, which I don't think is there. Even then, because of the competitive dynamics, I think companies will have to pass it to the end customer.
So at least looking good from the consumer point of view. But on that note, we'll wrap up this conversation and slip into a very short break. So Mahesh, Madan as well as Avnish, thank you so much for your time. When we return on the other side, we'll take a look at the GST impact on the insurance space and interact with an industry leader from that front as well. So stay tuned, we'll be right back.